Ladies and gentlemen, welcome back to Boss Economic World, where we don't just read the news, we dissect the carcass of the global economy to see what actually killed the patient. I'm your host, Boss, and today we are flying south. Way south. If you've been watching the headlines, you might think the economic war in the Andes is over. You see the tickers. Colombia inflation slows to 5.3%. Market beats expectations. Central bank relief. You might be tempted to pop the champagne, call your broker, and load up on Colombian pesos. Put the bottle down. Because today, we are going to peel back the layers of this good news onion, and trust me, it's going to make you cry. We are looking at a classic emerging market trap, a situation I like to call the zombie stabilization. The inflation number looks alive, it looks moving, but the underlying organs, the fiscal deficit, the wage spiral, the core pressures, are rotting from the inside. Today is December 6, 2025. While the Federal Reserve in the US is practically handing out free money again and Europe is trying to figure out if it's in a recession or a depression, Colombia is fighting a very different beast. Let's get into the truth behind the 5.3%. First, let's look at the official victory lap. The National Administrative Department of Statistics just dropped the November bomb. Annual inflation is down to 5.3%, cooling from 5.51% in October. Now, the experts, the 23 analysts in the Bloomberg survey who usually couldn't predict rain in a thunderstorm, they expected 5.46%. So, technically, this is a beat. The market cheered. The peso, which is trading around 3,832 to the dollar today, took a little breath of relief. Why did it drop? Was it brilliant monetary policy? Was it a sudden surge in economic productivity? No. It was tomatoes and potatoes. I'm not joking. If you look at the breakdown, the heavy lifting was done by a massive drop in food prices. We're talking about a minus 0.72% drop in the food basket. The weather gods, specifically the transition from El Niño to La Niña, decided to give Colombia a break. The harvest was good. Supply chains that were strangled last year finally loosened up. So, the price of your sancocho ingredients went down. But here is the first rule of Boss Economic World: never bet your portfolio on the weather. Food inflation is volatile. It's noise. It's not the signal. If you strip out the food, if you strip out the volatile energy prices, what are you left with? Core inflation, 5.2%. It barely budged from 5.25% the previous month. Do you see the problem? The easy inflation, the stuff that fluctuates because it rained last Tuesday, is coming down. But the sticky inflation, the price of haircuts, rent, education, the stuff that tells you how sick the currency really is stuck like gum on a shoe. A 5.2% core inflation when your target is 3% isn't a victory. It's a stalemate. And in economics, stalemates are where capital goes to die. Now, let's talk about the villain of our story. If the central bank is the doctor trying to cure the patient with high interest rates, the fiscal government is the guy sneaking hamburgers and cigarettes into the hospital room. We are looking at a projected fiscal deficit for 2025 of somewhere between 6.2% and 7.1% of GDP. Let that sink in. 7% of the entire economy is government overspending. President Petro's administration is currently playing a dangerous game of financial Jenga. They are using every trick in the book to make the numbers look better. We've seen swaps, we've seen debt buybacks, we've seen them raid the cookie jar of the financing laws. They are desperately trying to refinance about 16 trillion pesos for the 2026 budget. Why does this matter to you, the investor? Because a fiscal deficit this size is an inflation factory. When the government spends money it doesn't have, it pumps liquidity into the system that the central bank has to mop up with high interest rates. It's a tug of war. Governor Villar at the central bank is pulling on the rope with 9.25% interest rates, screaming stop spending. And the finance ministry is on the other side, printing deficits and saying just one more social program. The bond market smells blood. I was looking at the TES yield curve this morning. The 10-year yield is sitting around 12.01%. Sure, it eased a little because of the inflation print, but 12%? In a world where the US 10-year is settling down? That is a risk premium. That is the market saying, we don't trust you to pay this back without debasing the currency. Investors, listen to me, when a country's risk-free rate is 12%, nothing is free, and there is definitely risk. Now, let's look at the calendar. It's December. In Colombia, December isn't just about Christmas lights and buñuelos. It's about the minimum wage negotiation. This is the Super Bowl of bad economic decisions. Negotiations for the 2026 minimum wage have just started. The unions, emboldened by a sympathetic government, are asking for double-digit increases. We are hearing whispers of 11%, maybe even higher. There was even a floated proposal, perhaps a negotiation tactic, perhaps madness, of a 25% adjustment mentioned by some political outliers. Let's be conservative and say they settle on 10 to 11%. If inflation is 5.3% and you raise the minimum wage by 11%, you are handing out a nearly 6% real wage increase. Boss, that sounds great for the workers, you say. Sure, for the ones who keep their jobs. But for the economy? It's gasoline on the fire. In Colombia, the minimum wage isn't just a floor, it's an anchor. It's an index. Rent contracts, traffic fines, school tuitions, millions of prices are indexed to the minimum wage. If you jack up wages by 11% when productivity hasn't grown, businesses simply raise prices. This is why the central bank is sweating bullets. They know that if the government decrees a massive wage hike in late December, that 5.3% inflation number we saw today is going to U-turn and shoot right back up in January. It's the classic wage price spiral. The dog chases its tail, catches it, and bites it off. So, where does this leave the Monetary Policy Committee on December 19th? This is the dilemma of the century. The dovish case, look. Inflation dropped to 5.3%. The economy is slowing down. Food is cheap. We need to cut rates now to save growth. The real interest rate is almost 400 basis points positive. That's too tight. Cut, cut, cut. The hawkish case, are you insane? Core inflation is stuck. The government is running a 7% deficit. The minimum wage is about to jump 10%. If we cut rates now, we lose all credibility. We have to hold the line. Some economists, the ones who like to gamble, are predicting the first rate cut could happen this month. But the boss view? Caution. The Central Bank of Colombia has been the only adult in the room for the last 3 years. They know that if they cut too fast, and the minimum wage hike comes in hot, they will look like fools in January. Watch the vote split. It won't be unanimous. It's going to be a knife fight in the boardroom. Let's zoom out. Why should my viewers in New York, London, or Singapore care about Bogota? Because Colombia is the perfect case study for the post-COVID hangover that hasn't ended. In the US, the Fed has managed, miraculously, to engineer something looking like a soft landing. In Europe, the ECB is cutting because growth is dead. But in Latin America, we are seeing a divergence. Brazil is having its own fiscal tantrums. Mexico is dealing with trade rewiring. But Colombia stands out because it has a government that is ideologically opposed to the fiscal austerity the market demands. While global liquidity is starting to flow again, it's skipping Colombia. Why? Political risk. President Petro's approval ratings are in the tank, hovering around 30%. He is a wounded political animal. And wounded politicians tend to do populist things, like jacking up wages or blowing out the budget to regain popularity before an election season kicks off. The market is pricing this in. That 12% yield on the TES bonds? That's the Petro premium. The peso being stuck at 3,800 when the dollar is weakening globally? That's the fiscal discount. Let me break down a specific example to show you the absurdity of the situation. Cultural activities prices dropped in November. Why? Because people aren't spending money on fun. Demand is soft. That's the recessionary force. But services inflation of restaurants, insurance, maintenance is still rising. Why? Because business owners are pricing in the future wage hikes now. This is what economists call expectations de-anchoring. It's a fancy way of saying, I don't believe the government will fix this, so I'm raising my prices today just in case. And that, my friends, is the insidious nature of this 5.3% number. It's a mask. It hides the fact that the structural drivers of inflation, wages and deficits are stronger than ever. So, what is the verdict? What does the boss say? 1. Do not be fooled by the headline. 5.3% is better than 10%, sure. But the quality of this disinflation is low. It's driven by volatile supply shocks, not a structural cooling of demand or fiscal discipline. 2. Watch the wage negotiation. The number to watch isn't the inflation rate next month. It's the minimum wage decree on December 30th. If it's over 10%, sell your Colombian bonds. If it's over 12%, short the peso. 3. The central bank is trapped. On December 19th, even if they cut rates by 25 basis points, it's a token gesture. They cannot unleash a real easing cycle until the fiscal house is in order. And looking at the budget battles in Congress, that house is still under construction. 4. The opportunity? For the brave contrarian, there is an opportunity here. If the government somehow manages a moderate wage hike and the fiscal rule is respected, those 12% yielding bonds are a steal. You could lock in double-digit returns in a world of single-digit yields. But that's a big if. Final word, economic truth isn't found in the summary of a press release. It's found in the tension between a government that wants to spend and a market that demands payment. Right now, Colombia is right in the middle of that grinder. The inflation pressure has eased on paper. But in the real world? The pressure cooker is just starting to whistle. This is Boss. Keep your eyes on the data, not the drama. I'll see you on December 19th for the rate decision. Class dismissed.